Only reforms can put India's economy back on track. That's according to today's RBI statement, but joining me down the line to discuss his perspective is Wee-Khoon, rate strategist with Societe Generale. Wee-Khoon, the Reserve Bank also said the effect of its recent interest rate increase and liquidity tightening to bolster the rupee will fizzle out if the government does not move to reduce external trade imbalances. Is this in line with your perspective?
Yes, I think this is exactly what the Reserve Bank is trying to do, because the external imbalance is getting more and more important with the worsening of or weakening of the growth outlook in the region led by China, and also the kind of a normalization of policy in the Western world from the Fed in particular. So this is very important for India as now a very weak currency not only would weaken the trade imbalance, but also at the same time it would dampen market confidence on the ability for the government or for the central bank to contain or to maintain a strong, stable currency.
You mentioned China there. Some analysts have said that the slowdown in the Chinese economy had allowed the RBI some leeway to alter rates. Do you agree with this, firstly? And how large of an impact is China's ability to negotiate a soft landing having on India's economy, would you say?
I think the slowdown of Chinese economy is not only going to have an impact in India, but just the impact is going to be felt across the globe. But from India's perspective, the import or the export into China has slowed from 5.5% in 2011 to only 5% in 2012. So from that perspective, perhaps you can say that the impact is not as great as before, but in absolute terms, it will still have an impact. Whether it would give the RBI more leeway or not is hard to say, but I think with a slowing China, it will eventually lead to a slower global growth, or at least in the emerging markets area. And in a conventional sense, you would argue that they will give more room for RBI, Reserve Bank of India, to ease. But the problem now is the main focus of RBI is not on growth, but the focus has shifted from growth back to inflation, and more importantly, the current account deficit. If you see at the beginning of the year, they have cut twice on the back of a slowing economy. So that was a good reason to do then. If we have not had a currency instability in the past few months or so, I think the RBI would have eased further. But given what had happened since May, when Fed starting to talk about taper and all this outflow pressure and leading to a sharp volatility in the INR, I think RBI will be very, very reluctant to ease, even if growth were to slow. In fact, they have reduced their growth forecast to 5.5% in the latest statement. So it's true that the China economy will give RBI more room, but I don't think the timing is not great for RBI, and they are not going to react.
The central bank mentioned that the global financial tail risks are being outweighed by the Fed's impending tapering. However, given India's previously mentioned huge current account deficit, which some are expecting to climb yet further throughout the year, would you say that is in fact the biggest economic hurdle for India to face?
No, I think this is absolutely the most important issue in India for now, is the current account deficit. It's not an easy problem to solve. They have taken many measures. For example, they try to show up market confidence by and also attracting more inflow into the system, and also at the same time raising tax to hope for reduced gold import demand for gold, and thereby to address the current account issues. But I think all these issues are steps towards the right direction, but the impact is going to be not so clear-cut, because even though the measure is sound, but the effectiveness of the strategy is being questioned. I mean, this is not the first time India is trying to implement things to address the current account deficit issues, but so far all the reform that started since summer last year has not been effective. In fact, we have not seen any positive result out of it just yet. So I think this is really one of the most fundamental issues. Forget about growth for now. The current account deficit is really the issue for RBI, which is rather strange given most of the time central bank focus is mainly on growth and inflation. But this time around for India, in the special circumstances, current account deficit is the main issues. In fact, I mean, given this, they have also kind of explicitly mentioned for the first time in the release that because of this impossible Trinity dilemma, they are willing to forfeit some of the monetary policy discretion to address external concern for now. So, and at the same time, they also say the recent measure is temporary, but I think this temporary may be a long temporary rather than a short one.
Despite the slowing economy, the rupee still remains the battered currency. What is your outlook for it over the next 3 to 6 months?
I think if you just look at on the fundamental issues, there are not many positive factors for rupee to appreciate. I think one of the major one of the things that really drag rupee to current level is twofold. I think is the inability for or is the stickiness of the inflation. Even though inflation has come down from the high, there are still underlying a strong inflationary pressure, and the constant hawkishness of the RBI tone doesn't really help. And secondly is the current account deficit issue that we mentioned earlier. Without that being addressed, I think it doesn't matter how aggressive RBI trying to address the issues, the market would just not have the confidence for RBI to effectively address this issue. I mean, as we speak, the INR has already once again broken 60 level. I mean, if they continue to depreciate, RBI would have no choice but to tighten liquidity even further, just to try to stem out the remainder depreciation pressure.
Wee-Khoon, thank you very much for your time and perspective today. Well, viewers, that's all from me for the moment, but click back to Dukascopy TV for an energy-orientated commodities corner with my colleague Natalie MacDonald. Goodbye for now.